HedgeNordic, your single access point to the Nordic hedge fund industry.
Now, Jonas, can you start off by describing the strategy that is employed by Rest Life Investments?
Yes, thank you. And Rest Life Investments has since 9 years invested in US life insurance policies. And this is a very interesting asset class that offers completely uncorrelated returns, which is difficult to find for investors in these days. The secondary market for US life insurance policies has existed in approximately 100 years, and it enables policy sellers in the US to sell their policy at a higher price than the surrender value offered by insurance companies. So it's something which is really positive for consumers in the US, and it's a highly regulated market. We've had congressional hearings, etc., and 45 states are regulated.
And can you also briefly walk us through the whole process of buying a life insurance policy, and how do you make returns on a given purchased policy?
Yes, absolutely. Now, what happens is that, let's say we have Mrs. Smith, and she's now 75 years old, and her children are grown up, they're working, and they're making their own money. She has no longer the need for the life insurance policy, and has therefore decided to stop paying the premiums. This is actually the most common alternative. People just stop paying the premiums, and the policy will lapse within 60 days. And this is what happens to 90%. So 9 out of 10 policies in the US will lapse without paying out. So for the life insurance companies, this is a very profitable product since most policies never pay out. So what the secondary market does, it really offers an alternative, because suddenly Mrs. Smith can actually sell her policy to a fund in the secondary market.
Cristina, can you describe the average policy holder of the policies that you predominantly aim to acquire for the fund?
Yeah, so we're looking at the average policy holder we're willing to acquire is actually quite healthy individuals that are in the late 70s. And they're with life expectancies which are typically 10 years, on average 10 years, so quite long. They're expected to live for quite a longer time. They're also quite wealthy individuals, because we basically buy on average policies that have a $2 million on a face value. And they're therefore also quite well educated. So let's say we're focusing on the quite healthy and wealthy individuals. And as Jonas mentioned, the reason why they're selling their policies, because they're now 79 plus years old. They retire, their children have gone to university, they don't need this policy anymore, and then they're well informed, they know that they can sell it, and that they can actually monetize these assets they own, and therefore they decide to sell in the secondary market. And the secondary market offers that opportunity to policyholders to actually being able to receive, a decent amount for the policy they have been saving up for many years.
And what returns should your investors expect from an investment in Rest Life Investments? And looking back at your performance, how would you assess your fund's performance in recent years?
So our target return is 7 to 8% in US dollar net of fees and without any leverage. We have had quite a strong performance over the past 5 years. So our annual performance on a 5-year return is 7.1% with a Sharpe ratio of 1.5, so quite a very good risk-adjusted return.
What are the main barriers to entry in the secondary market for life insurance policies? Is it the J curve or the capital intensity to invest in the market?
I think it's very much an OTC market where you are relying on finding good policies through brokers. So to start off with, if you're an unknown market participant, you don't know the brokers, you don't know which brokers perhaps have access to attractive policies, you may find yourself that it's rather difficult. Also, of course, when you launch, you own 0 policies, then you buy 1, then you buy 2. So your portfolio is not very diversified. You don't really expect any policies to pay out in the early years. So there is, of course, as you mentioned, a kind of J-curve effect there. It takes time really to build a diversified portfolio. I mean, we started 9 years ago, and It took time to reach 100 policies. It took 2 years for the first policy to pay out. So I think it's a lot of admin, a lot of knowledge, getting to know the market, getting to know the market participants. So it's high barriers of entry and not easy for newcomers.
Jonas, can we also discuss some of the main risks associated with life settlements investing? And what is your approach to managing those risks?
But there are no risks. No, absolutely. Now, the key risk we take, of course, is the longevity risk. The fact that people live longer and longer in the Western world. We know that. I mean, everyone knows that. It's a well-known fact. So what we are doing is we're basically trying to say, how can we mitigate the longevity risk? Well, what we do is we try to buy longer life expectancies. We buy policies from people who are very healthy. Why? Well, because we think that long life expectancies are more accurate. And at the end of the day, the only thing we care about is really having accurate life expectancies so that we can deliver our target return of 7 to 8% net in US dollars. We also buy mainly single policies, so we are cherry picking. We have reviewed over 10,000 policies since inception, and we bought approximately 400 policies. So we are very picky, very selective in what we buy, which we think is also good for our investors. We also try to target certain characteristics in the policies we buy. As an example, low premiums would be an obvious one. If we can choose between X number of policies, we will of course choose the one that has the lowest premium streams. It may sound obvious, but it's not so easy to find these very attractive policies. So in essence, what we're doing is we're buying very selectively, trying to buy policies where we feel the risk is lower for our investors. And by lower risk, we mean lower sensitivity to increased life expectancies.
Cristina, can you explain how your fund and your approach to investing is an example of socially responsible investing?
Yes, so we really think that life settlements is a sustainable investment, which gives a lot of value, provides value to both the sellers and also the buyers in this case. And basically, like we said before, a life settlement transaction starts when Mr. and Mrs. Smith, a policyholder, want to sell an asset they no longer need. And basically, by having the opportunity to do that, to sell it on the secondary market, they're getting value. It's good for the consumers, good for these policyholders. Before the life settlement market existed, the only options they had is to let the policy lapse, basically get zero, or to get a surrender value that the insurance companies would provide, which would be a symbolic amount between 10,000 and 20,000 euros, so very far from the actual face value of the policy. So we actually think that it is very positive, in that sense sustainable, in the sense that it's adding value to consumers. And it's also disrupting a market where the insurance companies have the absolute pricing power over the policies.
HedgeNordic, your single access point to the Nordic hedge fund industry.